With interest rates at heights not seen in nearly 2 decades and traditional lenders still shell-shocked from this past spring's bank runs, private credit, or non-bank direct lending, is booming on Wall Street. Yield-chasing institutions have poured into the sector, which now amounts to $1.5 trillion globally. But pension funds, endowments and other big players need not be the only investors feasting on high yields. A great way retail investors can partake in private credit's spoils is by buying the stocks of business development companies, BDCs. These outfits are required to lend to small or medium-sized businesses, which usually don't have access to public debt markets. There are more than 130 BDCs, according to the Small Business Investor Alliance. The largest is the $48 billion Blackstone Private Credit Fund, BCRED, which yields about 10% currently. That fund is sold exclusively through financial advisors and limits redemptions at book value to once per quarter. But Blackstone and every other major private equity firm, including KKR and Apollo, plus credit specialists like Ares Management and Blue Owl also offer publicly traded BDCs with daily liquidity. These funds are currently offering annualized yields from about 6% to more than 16%. Most BDCs are required to pay out 90% of their earnings to investors as dividends, and the majority of loans in a typical BDC's portfolio are floating rate, giving them a measure of protection against interest rate swings. Many BDCs, such as Blue Owl Capital, OBDC, which has $12.9 billion in assets, have raised their dividends this year and are also throwing in supplemental or bonus dividends, promising to pay out 50% of any excess earnings beyond the base amount. The bonuses reward investors during good times but also let BDCs avoid dividend cuts later when interest rates retreat. OBDC's base dividend for the third quarter was raised to 35 cents per share and came with an 8-cent bonus, implying an annualized dividend of $1.72 or a 12% yield at its current price of $14.38. OBDC trades at a 7% discount to its book or net asset value. You're earning equity-like returns in a defensive portfolio of loans. Crow's Craig Packer, co-president of Blue Owl and CEO of OBDC, which has 83% of its portfolio in senior debt, the type that gets paid early in a bankruptcy. Blue Owl, which went public in 2019, had a 12.7% return on equity in the third quarter. It specializes in lending to software companies and non-cyclical sectors like insurance brokers, which have consistent recurring revenue streams. Ares Capital, ARCC, the largest publicly traded BDC with $21.9 billion in assets, has an 11.2% average 6-year return on equity, though its stock trades at a 3% premium to book value. Higher interest rates and a strong economy have meant happy days for BDC investors recently, but don't count on them lasting forever. The average return on equity since IPO of 28 BDCs tracked by Oppenheimer is just 7.4%.